freedom isn't the result of wealth. It's the foundation. Welcome to Wealth Independence, where freedom leads and real wealth follows through battle-tested strategies, hard-won lessons, and real-world experience. You'll discover how to accelerate your path to true financial independence. And now your hosts, Dustin Bailey and Adam Penn.
All right, welcome back to the Wealth Independence Podcast, where freedom leads and real wealth follows. I'm Dustin Bailey, and I'm here with Adam Penn. Adam, how you doing today?
I'm doing well, Dustin. Happy to. You asked me what the topic's going to be today, and I feel like this is it's an interesting viewpoint that I don't think a whole lot of people really think about, right?
You know, we've gotten some we've gotten some feedback that you and I should banter
more
a little bit before just diving right into it. You know, you're always like just ready to go as soon as we dive into these episodes.
That's because I want to spend less time on the phone with you.
I think, well, that too, and I also think that represents your execution style, right? You're like, don't think about it, just go do.
Just do it.
Just go, just dive right in.
Yeah.
All right, that's enough banter. I think we've satisfied the critics who said we needed to banter a bit. So, what do you got for us today?
It's 50% of our audience that thinks that, right? It's one person.
Well, probably, yeah, but that's fine.
Okay.
Anyway, no, you texted me this earlier. I actually am curious. I think this is a relevant topic for a lot of folks. So, tee it off for us.
I will tee it off. So the thing that I think is an interesting topic for today is investing as an investor, right? And earning all of your income basically off a principal versus investing while you have a W-2 job or a business, right? Really taking that transition from being someone who earns their income elsewhere and is able to add to their principal balance of their investment portfolio, right? I mean, when you start investing out of college, high school, middle school, depending on when you started, right? Kindergarten, I don't know. Some people start early.
My dad bought me my first share of, well, it was in his name, but he was like, this is for you. It was in First Tennessee Bank at the time. I don't know. I was like 6 or 7, but I learned what a stock was. And like, I was watching the share. I can remember they would post it in the paper, right? And I would go look in the paper and see if it had gone up or down. So yeah, I mean, you can definitely start early with this. Sorry, I interrupted you there.
I just remembered you're older than me. I've never looked at a stock price in a
when I would look up stock prices in the newspaper. I lived in a rural. I still do live in a rural town. So like we did. This was pre-internet, man.
Okay, so back to the point. If you have an income, right, and you're able to at one point start investing, you're building your principal balance from something else, right? It's not really the investment compounding. It's not the investment earning, let's say, you have $1 million portfolio earning 10%. You're not earning 100,000 living off of 50,000 and adding 50,000 to the principal, right? And then the next year you have $1,050,000, right? You are working maybe a W-2 job, making $100,000, $200,000 a year, living off of, say, half of that. Let's just say you're making 200, living off of 100, and you're investing that other 100. And that other 100, that means in 10 years, maybe you have $1 million plus whatever growth it had. But it also means that if you make a bad investment, and let's just say you lose a $100,000 investment, it's really just another year of work. It sucks, but it's another year of work to get back that principal, right? Another, $200,000 income, live off of 100 of it. Maybe you live a little less. Maybe you save 120,000 that year and build your portfolio back up. And the portfolio, then that doesn't matter the performance of the portfolio at all, right? But if you had just $1 million portfolio, no job, living purely off the portfolio, just purely keeping that siloed as just an investment portfolio, and you lose $100,000, there's no job that's just going to make that back, right? The rest of the portfolio needs to perform at a 13% yield to get you back to that million, right? That's assuming you're not taking any distribution there. And I think that's a mentality that I won't say it's hard for people to grasp or even hard to live with, right? But it's a different risk tolerance you have to understand. I remember when I was starting in syndication 5 years ago, I did a little deal where we raised $175,000 with a few of us to go invest in a syndication. It was really just a partnership. And I raised $12,500 from two people. One was my dad and one was my girlfriend at the time. And I looked at both of them like, it's $12,500, right? Like this is not a lot of money, right? If you lose this, right, this is not your investment portfolio. This is not your livelihood. We did well on it, but it was one of those things where, you start to think about everything kind of with a risk adjusted basis. And the risk around investing a minimal amount of money or a trivial amount of money compared to what your income is has a different risk profile than investing 10% of your net worth that you are living off of. And I think that's especially important right now, is where, it's April of 25 as we're recording this. And I'm pretty sure I had at least 15 pings this morning from Robinhood letting me know not to sell everything off in a panic. Right? Because everything is down like 10%. I get like one Robinhood notification day. It's like when it moves over 5%. Every one of my stocks outside of Hershey's down 5% plus today. I don't care. It's like I've said before on this podcast, it's a minimal amount of money in there that I kind of just do to watch it. But if that was something you were living off of, that's, or planning to sell, what if you retired last week and were planning to start selling off shares?
Yeah. That last point right there is an interesting thing that I've seen a lot of folks talk about, that, you have sort of the view in the stock investing space, and the 4% rule gets talked about and things like that. But I've seen some research on this in the past, that what really matters more is honestly for retirement in that sort of model. If the plan is to sell off your nest egg, right? Like the traditional view of retirement, the timing of when you retire has a massive impact on how long. That's the balance of how long the money lasts versus how much you want to live on per year, right? Because those are directly correlated. So if you retire into a down market and immediately, you're right. As of this morning, I actually haven't been paying that much attention, which is probably a separate topic we can talk about. Because I'm not worried. I'm looking at some of the deals we're looking at right now, and I'm like, well, none of this changes anything for any of these deals, right? Like, I'm excited that the 10-year is dropping. That just means more favorable debt on some of these apartment deals and better cash flow. So I'm like, okay, this seems like it's good. Anyway, that's a side topic. But I think that, like, if you end up retiring and you see right off the bat, if you were heavy in NASDAQ, the NASDAQ's entered a bear market, a technical definition of the bear market, which is 20% off of the most recent high. And that, if you had a significant portion of your net worth in either the NASDAQ as an index or like stocks that are most usually tech stocks there, and you're like, okay, I was thinking about retiring, you're probably thinking like, I don't know, I might need to work a little while longer. And anyway, the opposite's true too, right? You retire, let's say at the bottom, and right before stuff just really takes off. Now all of a sudden, holy crap, maybe you'll look at it and think maybe you should have retired sooner. You can have a better lifestyle in retirement. Anyway, I could kind of go back and forth on that. But I think going back, you look like you want to say something. Go ahead.
Just to take that back to kind of our base investment philosophy and the things that we like to invest in, right? Like, this market dip didn't slash any of our rents this month on any of my properties. I will say that, I've got a buddy with a larger multifamily building, and he did see a rent decline in this last month. He's seen about a 5% drawback in rents, right? But even that, on a 300-unit building, some rents were up, some were down, right? This is a slower leasing season. It's a college area. So you don't normally see a lot of college leases in April. Yeah. So you're just not seeing these massive dips. And I think the part that actually I like the most is around the psychological side, is all you can do is manage the situation when you're in real estate, right? Like, you're going to manage the rents, you're going to manage the cash flows. You could consider selling, but it's a longer process. You're not going to have some panic sell button or buy button, right? Like, it's slower moving. Maybe even a little bit back into the way that, like, the U.S. was built to be a slow moving government, right? Like real estate is slower. You can't just freak out and make things change overnight, right? So
you must have been reading the newsletter that went out today, because I actually wrote on this exact topic about how liquidity, people like to keep a lot of their net worth. You'll hear people say, well, it's nice to have it in stocks because it's liquid. I can get to it if I need it. And it's like, okay, well, what trade-offs are you making? Like, first of all, do you need the liquidity? And second off, what trade-offs are you making by having that? Because it's not this just unqualified good thing, right? There are downsides to it. Volatility being the biggest, right? So like Adam, to your point, when you're heavy in real estate, like you can't just you can sell, but it's a longer process, and that it's much higher friction, and I think it makes you. Robinhood's obviously having to send a lot of alerts today telling people not to panic sell, right? Like your rental property doesn't send alerts saying, "Hey, wait a second, don't sell me. It's okay."
Calm down.
Like
The
like
county
that doesn't
assessors out there sending letters. Don't crash real estate values. We need these taxes.
exactly. So like that lack of liquidity and the greater friction in real estate, I think it reduces volatility because you don't have these panics, and you don't have the euphoric buying on the other side, right? Like it tends to be more muted.
Sometimes. So 2020 was a little bit of euphoric buying.
That's true, but it plays out over a longer time frame,
Yes.
right? Like you're not gonna have that's gonna happen over a year as opposed to a week or something like that. But
also, you normally pair it with fixed rate debt and fairly stable rents, right? So it's just, your dividends are a little more stable and tied for a year. Your expenses for the most part. I think it's just overall a little easier to balance out a real estate portfolio.
Well, we've kind of deviated from your initial thesis here, or the initial topic about.
Kind of. We've talked. Maybe we went back to just our initial base thesis, but I think if we drive it back to what we were thinking about, which is when you're living purely off of an investment portfolio, your psychology changes a little bit, right?
Yep.
And that's true for everyone, right? I mean, like I had earlier this year, I had a software job where we were, I was a 1099 employee, and don't get me wrong, it's hard to lose that monthly check that you get, right? Like it's, that contract ended. I mean, it was a contract basis. I knew it was going to end. And that's not a problem, right? But then you're like, okay, once again, now that money's not going back into my basis of my account every month, right? Or it's not going to pay whatever bill or conference we go to or business venture, right? You're now having to either as a business owner generate enough revenue to pay yourself and pay your employees and cover the random things that shoot up. And then as an investor, you're having to make sure to make informed investment decisions that will grow your portfolio, and you won't have massive reductions, right? And a lot of that comes back to position sizing and things like that I've talked to. So I think really the point I'm trying to drive home here, and add whatever you want. Also, real quick, I'll pause. If anyone is enjoying this conversation, please do like and share this and post it and send it to friends and do all the things. If you're on Apple podcast, Apple Music, I don't have
Apple
these
Podcast.
iPhone things. What is it? Apple Podcast. Can you leave a review? All of that helps get this out here. It would, if every one of you shared it with 2 people, we might be up to 3 listeners next week.
That would be amazing. We would be forever indebted. Take a screenshot and send it to us that you shared it with someone, and we'll send you something. I don't know what it
maybe a mug. We could send them a mug.
We could. Yeah, get one of those nice mugs.
I've got a few of those left.
I'm glad you plugged that, because yes, we definitely would appreciate anyone who is listening. If you're enjoying it, definitely support us through smashing that like button. But depending on the platform, for sure, leave us a review, engage, whatever it is on the whatever platform you're consuming this.
But really, the point is that the transition to a full-time investor has a different psychology around it, right? I mean, it's even for me and you, right? We were in the tech industry. If we went out and found like an in-office full-time job, we could probably be making $200,000 to $400,000 a year. That's a hard thing to just constantly say no to. And your mother likes to remind you that you could always go back and get your tech job.
She does.
But
sorry, I don't want to cut you off.
But and that's not something that you can just say no to. But I think as you start to balance out the two, and you see that, hey, your investment income starts to surpass your other income, and you're learning more about investments. I mean, everyone's going to make a bad investment in their life. I mean, even people I know who are incredibly successful have lost $1 million or so on a bad deal, right? I mean, the number just gets bigger the more your portfolio grows, right? You end up with a $50 million portfolio. those 10% allocations, you'll probably drop down to 5%, but that's still $2.5 million that you'll be putting in deals, right? So one of those blows up, there goes $2.5 million, because it's harder to go write a bunch of, you're not going to go write 500 $100,000 checks and manage all of those and find that many valuable deals. One thing that Bob Frazier, who's going to be on this podcast probably later this year from Aspen Funds, was talking about is when I was just out in Breckenridge with him last week, he brought
at his house.
At his house, beautiful house, yeah, beautiful, brand new build.
You're hanging out with Bob.
He's got a glue lamb in one of the spots that is curved. One of the beams in the roof is curved. I mean, it's just gorgeous. Part of the beams in the top, they didn't want to have the beams go together. They want to be more open, so they added steel bracing, like round tube steel bracing, so it's all open. Gorgeous home. Anyway, I digress. We do like real estate, even especially the pretty stuff. The point that he brought up to me is sometimes people have these large exits. Let's just say you have an IPO exit and you're going to have $2 million to go deploy. Now you have enough income enough of a portfolio to go build passive income. You don't have to deploy all that in the first year. And I think I've seen just personally in the last 3 years, a lot of people make that mistake, right? They have a windfall, whether or not I've seen some people who are successful investors, 10, 20, $30 million portfolios, get a $2, $3, $4 million windfall from a sale of a property, a capital gain, whatever. They're either worried about paying taxes on it, or they just feel like they need to deploy it. They don't want it sitting there. And so they just go find the best deal that's right now. And Bob brought up an interesting point. He's like, you don't need to deploy all of it, because then you won't be able to invest in the best deal next year, because you're all tied up in the mediocre deal you picked this year. And that's not saying wait always for the next better deal, but you got $1 million to deploy, pick 3 deals this year. This isn't investment advice, but pick 3 deals this year, pick 3 deals the next year, pick 4 deals the year after that, right? Wait for the thing that really makes a ton of sense. You're like, oh, this is it, right? So anyway.
No, that was all excellent. You covered a lot of ground here. I should have been making notes because I was having thoughts as you were talking there, Adam. On that last point, I like portfolio construction becomes very, very important. Obviously, the larger your portfolio grows, but then also to your point, if you have to pay a lot more attention to that, if that becomes your sole income source, if you are living off of the cash flow that your portfolio is producing, then yes, you have to be very careful about not doing things to destroy the cash flowing part of that portfolio, right? So I'll take not a contrarian, but maybe I think my view on this has changed a little bit. You made the comment earlier about it being hard to like walk, when you have a contract or a salary or something like that, it's hard to walk away from. And I think back to when I left Twilio almost 3 years ago, like that was such a hard decision. And it was really, I mean, every week, or not every week, but every 2 weeks, right? That direct deposit's hitting the account. And I'm sitting here looking at it like, am I really about to walk away from this? And not only that, but then there were options, which of course at the time the Twilio stock had tanked, and the options weren't worth what they had been, but still it's like, am I really going to walk away from this? And that in and of itself, regardless of whether it's for, to become a full-time investor, to go do a new venture, like walking away from stable income is tough. And like there's definitely like this, like you have to have a lot of fortitude to be able to do that. And then there's something that does have to shift where you have to be like, okay, if I know that's not coming in, I've got to now be more careful about the sources that are, whether that's starting a business or again, just becoming a full-time investor. You have to be very mindful now of, okay, if this is what I'm living off of, I need to probably play a little bit safer. Whereas when you've got maybe multiple 6 figures of investable income coming in every year, you can afford to make some mistakes. Where I think my views on this have changed, I used to be very like, okay, everyone just needs to go, like, you need to go make enough money and invest and quit your job and like go do what you want. And I think that view has changed, where I don't feel as strongly that like that's the right path for everyone. I know that that's not the right path for everyone. And so, we talk about making that transition. That's a good thing, but it also, you might not have to transition, right? Like if you enjoy your job and you still want to invest on the side, like there's obviously nothing wrong with that. You keep working. there's nothing wrong. Like we've got a lot of investors who have their own businesses, right? So they're business owners, and that kind of in a way provides the source of income, right? What's the net income, or they may draw a salary from their business, whatever. That, like, their business now is where they're not really a full-time investor, but they're spending their time on their business. They're getting their capital there. That's where they're getting, in a lot of ways, their sense of fulfillment, because that's really the larger source of this. And like, again, this is maybe slightly off topic, but if you transition to become a full-time investor, it's like, okay, well, are you spending, is now like the main purpose of your life to invest? Probably not, right? Like most people will retire. And I mean, I certainly experienced this myself after I left Twilio. I mean, there was a period of decompression. I was very burnt out, and I didn't realize it until I left. And so, yeah, I would have chilled out on a beach for 2 or 3 months. But honestly, like, and I kind of, I did take it a little bit easy. But then honestly, after like 2 months, I was like, okay, I'm ready to go. Like, I got to get back into something.
That's where I think a lot of people could go down to a part-time, especially if you're in the tech space and you're an experienced architect or developer. Like, you could find a 20-hour-a-week job. Let's be honest, you probably get most of your work done in those 20 hours anyway, so the company is going to be happier. And you're not going to have to be there, right? You're going to work 2-3 days a week. I knew someone that was going into retirement, and they went down to Monday, Tuesday, half-day Wednesday, Thursday, never Fridays. And they liked that schedule. They had 3-day weekends. They take PTO when they wanted. They enjoyed their work when they were there. They enjoyed being gone when they were gone.
That's not bad. But yeah, I mean, and I think that's you. I feel like this a lot of times gets presented in this like very binary thing, right? Where it's like, okay, you're going to work, you're like the corporate drone stuck in the rat race or whatever. Which that may be true, and that can definitely be a motivating factor to get out and invest in things that are going to produce cash flow. But at the same time, you don't have to hate your job. If you love your job, that's great. But I think that our investment thesis still kind of holds in where, okay, you still want to produce cash flow, right? Because then that provides optionality. Whether, maybe the situation changes at your job and you want to walk away. If you can then live off of the investment income, that's great. There could be other changes in life. Certainly seen people where they've had either them or a loved one has had some kind of health diagnosis that sort of changed things. And like, okay, well, I loved what I was doing, but I can't devote that time to this anymore. And so, slowly building up that portfolio on the side of cash flowing assets, whether or not you're actually like spending the cash or not, maybe all of that's just extra investment income, right? You let it compound, or you save it up in an account, and every time you got another 100 grand, you go find some other deal to invest in. Nothing wrong with any of that. So there's not one right approach to this, even though I think, again, this gets presented on social media and on TikTok and YouTube. Everyone's like, it's this very binary thing about get out of the rat race, leave your job. You may have a job and not be stuck in the rat race. So there's different ways to do this, but we still think there's a lot of value in building up this portfolio of cash flowing assets. And then when that does become, to Adam, to your, I think, original point here, when that does become the main thing, your risk tolerance changes. How you evaluate investments change, because, okay, now I don't have this either a business or a job that's, providing some backup income now, so to speak.
Or even that investment's just making so much income that your business or job no longer supports it, right? Like maybe your basic living expenses are there, but like I know people with large multifamily buildings that do not want to put debt on them, like 300-400 unit buildings, multiple of them, because they're 80. They don't want to have the debt risk. They don't want to refinance. They don't want to deal with any of it. So they own it 100% cash. They're just happy bringing in a few $100,000 a month.
Yeah.
Because there's nothing else they could do that will do that except for grow their portfolio and buy multiple units, manage all of it, manage the debt, deal with the risk. They've owned the building for 30 years. They paved the parking lot last year.
Yeah.
Right? Like,
well, and yeah, and I mean that can exist on smaller scales too, right? Like I think we recently did a case study on was it citrus that we talked about, where basically the cash flow, one of your properties in Chico that had cash flowed for so long, and you paid for a kind of a full renovation last year completely out of the cash flow.
Yep, I did.
Yeah.
Yeah.
So it doesn't have to be like, obviously we love the bigger stuff and the bigger stuff has bigger numbers, but it doesn't always have to be that. And this same idea can exist on a smaller scale.
Well, anything else you want to add to this topic?
No, I guess this was, I'll throw the onus back on you. This topic was your idea. I guess if there's one takeaway that we wanted to leave folks with, what do you think that would be?
It's very nice to have a job to fall back on. It's also very nice to do what you think you want to do, right? If it's be a W-2 income earner and just build a side investment portfolio so you have a bigger buffer, do that. But if you don't want to be the W-2 person, it's a lot of jobs out there. You can, it might be hard to find one, right? You might not get the exact job you had, but if you're at the point where you feel like you want to leave, give it a try, right? I mean, I was fired from my first job for not being vaccinated, and then I got a contract, and then I went back to being a full-time real estate investor. Then I got another 6-month contract that lasted 2 years, and then now I'm back to full-time real estate investing, right? We've been doing the same thing, right? Growing the business, doing all the things, but you can kind of bounce back and forth. You can mix and match and do what you want, right? Don't put yourself at a huge risk, but
yeah,
unless you're the CEO of a company, you can probably go get that job back.
The piece I would add to that is if you are going to leave, I hate when I see people do this, but don't burn bridges, right? Some folks get, especially if they get so burnt out from a job, they'll leave in a bad manner. And you want to keep option. I mean, whether you have to go back or eventually want to go back, right? Some folks are like, okay, I've done this for a while and like, this is great. I'm making enough money, but I got to have something to fill my time. Like I'm literally bored all day long. Mm-hmm. And so whether that's part-time or something else, and you don't want to burn connections from something previous, because you never know whether that's a job or it's some other opportunities, right? Like you always got to keep doors open. And Adam, I think that's a really good point that like you can kind of bounce around, see what opportunities come along. The more connections you make, the more opportunities there are, and you find out that you got a skill set and can help this person. And so yeah, there's a lot to do there. But I guess to go back to one of your original points, my main takeaway would be if you make that transition, you cannot approach your portfolio and your risk tolerance the same way once you're only living on investment income as you did when you had income from either a business or a job. And so that's definitely something that if you are going to make that transition, you got to be very mindful of the risk of those investments, not of the existing portfolio, right? Like could something dry up in is there more risk in the existing portfolio then you might like an investment that you wouldn't make now that you did make. You're like, okay, maybe this could go away. And then also that applies to new investment decisions as well. That would probably be the takeaway that I've got.
Awesome.
Cool. If you don't have anything else, we'll get on out of here. And if any listeners, if you got any thoughts on this, we'd love to hear from you. wealthindependencepod.com. We got a contact form there. You submit it, and we'd love to hear your thoughts, or you can connect with us on social media. But Adam, if you don't have anything else, we'll mosey.
All good.
All right. Well, thanks everybody for listening. We appreciate it. And just remember, where freedom leads, real wealth follows. Thanks everybody.
Thanks for joining us on Wealth Independence. This show is for informational purposes only and is not financial, investment, legal, or tax advice and does not constitute an offer to buy or sell securities. All investments carry risk, and investors should always conduct thorough due diligence and consult with qualified professionals before investing. Until next time, remember, freedom leads and real wealth follows.